Hello, this is Dr. Akwesi Ampofo, and I'm going to record a video on the differences between financial accounting and financial management, and I hope this will be helpful to you. For financial accounting, we are trying to record economic or financial information in the form of a profit and loss account, balance sheet, and statement of cash flows, along with some explanatory language for users of financial statements. And the users of financial statements will be investors, management, creditors, banks, and others. Those are internal or external users of financial statements. So that's what financial accounting is. If you really want to understand it, you have to really understand what we mean by an asset, a liability, and equity. Okay, that's the accounting equation. The accounting equation says your assets equals your liabilities plus your equity. In other words, if you put $100 in a bank or $100 to start your business, put that in a bank, it will be equal to however much you borrow. Let's say you borrowed 50. So if you borrowed 50 and you added $100 to that's 150, that's your asset. So liability plus equity equals your assets. So just make sure you understand the accounting equation. It's very important, okay? What is an asset? The formal definition of an asset is that it is an economic resource. You have a right to economic resources like buildings, cars, computers, laptops. All those are assets. Typically, we differentiate assets into two categories. One is what we call tangible assets, assets that you can hold and touch and feel like buildings and cars and computers, or intangible assets like intellectual rights or customer rights and things like that. You cannot hold them, but they are also assets. You can also look at assets in terms of current versus non-current, whether the asset you can get the money within 12 months or after 12 months. If you can get the money within 12 months, like cash and CDs and cash equivalents, we call them current assets. If you cannot do that, but it has to be after 12 months, we call them non-current assets. So make sure you understand that. Now, what is a liability? A liability is just an obligation to pay money to another third party. So if I have a bank loan, I have a mortgage, I have a car note, all those are liabilities. If you have accounts payable, it's a liability. If you have expenses payable that you are yet to pay your employees, you are yet to pay for your rent, all those are liabilities because they are obligations to pay somebody else from the perspective of the business. Now, what then is equity? Equity simply means capital. It means money that you invested in the business plus any profits that you have accumulated over time. And it is calculated as asset minus liability. So if my assets are 150 and my liabilities are 50, then that means 150 minus 50 is 100. That's my equity or capital. Some people call it net assets, and that is rightly so because it is asset net of liabilities. So that's what it is. Now we go to the three main types of financial statements that every accounting student, every finance student, every management person is expected to know. These are number one, what we call the statement of comprehensive income, also called a profit and loss account, P&L account, as you hear in colloquial language. The profit and loss account records your revenues, which is money that come into the business, and your expenses, which is money that go out of the business because you're spending them on using your assets or using your liabilities. Examples of revenue would include for an insurance company, for example, will be premium revenue. For a university, for example, it will be student fees. For a car dealership, it will be revenue from selling cars. For a law firm, it will be legal fees that they received from the clients. So revenue is money you get from your primary or central activities. Don't forget that, all right? Now, let's go to expenses. The basic definition of an expense is an expired cost. When they say that, what they mean is you incur an expense when you use an asset. For example, if you use a building, you have a rent expense. Use your car, you have depreciation expense. Use your laptop, we have depreciation expense. If you use somebody's money, it generates interest expenses. And so that is the definition of an expense. You subtract your expenses from your revenue, and if the revenues are more than the expenses, you're going to get what we call a profit. So let's say your revenue is 100 and your total expenses is 80. Then 100 minus 80 will give you 20. That's what we call profit or net income. Okay, that's basic. But if the expenses are more than the revenue, you get what we call a loss. So for example, if your revenue is 100, but your expenses are 180, you subtract 180 from 100, you get negative 80, and that is what we're going to call a loss. So that's really what a profit and loss account is about. Now let's go on to the balance sheet. The balance sheet is a snapshot or a picture of your assets, liabilities, or equity at any point in time. So when we talk about an asset, I've already defined it. But when your asset increase, we use the word debit. When your expenses increase, we use the word debit. So an increase in an asset or an expense is called a debit. And a decrease in an asset or an expense is called a credit. When it comes to liabilities, equity, and then liabilities and equities and revenues, when you increase them, we call that credit. And when you decrease those three things, we call that debit. Don't forget that. That's very important. So now that we know what our financial statement is, it's going to show a list of our assets, a list of our liability, and a list of our equity. It has to balance because your asset must equal your liabilities plus your equity. That's what we call balance sheets. That means they are the same. So for example, if your assets came to $100 and your liabilities is 80, then by definition, your equity has to be 20. So we call it a balance sheet. Now, the balance sheet and this income statement or P&L account is not sufficient. We need to understand where the cash came from and where it went to. So we come up with a third statement that we refer to as the statement of cash flow. Some people call it cash flow statement. And what that does is it tries to explain the difference in cash. So let's say at the beginning of the year, your cash balance was 100. At the end of the year, it went to 150. It increased by $50. Why? In order to explain this, we use 4 reasons. 1, cash flow from operations. Is it because you bought and sold goods in your business that the cash went up? And then 2, cash flow from investing. Is it because you invested in stocks, bonds, buildings, cars, and things like that? Or you sold them and got money, or you paid money to buy those things? That's investing cash flows. And then 3 is financing cash flow, which is cash flow that you either borrowed or you repaid your debt. Okay, so that's what financing cash flow means. And then the last category of cash flow is not very popular, it's very minute. Not a lot of business have it. We call it the effect of exchange rate on cash balances. Okay, the effect of exchange rate on cash balances. So that is the cash flow statement. And so that is important because it helps us to understand where our cash came from and where we spend cash. Because the income statement includes cash, but it also includes accruals. And those accruals are not cash. And people want to know what is exactly the cash position. And that's what makes the cash flow statement very important. Last but not the least on the financial statement is the disclosures. The disclosures explain the main things on the income statement, the balance sheet, and the cash flow statement. What are your biggest assets? What are they? Tell me the nature of them. What is the amount? What is the timing? What should people know about those big assets, big revenues, big expenses? So it's just a narrative to describe the nature, amount, and timing of the cash flows related to the things that I just talked about. That's what the disclosures are. So you may have a footnote disclosure on revenues, you may have one on the payroll, you may have one on assets, you may have one on liabilities, and so forth and so on. Now, just to level set, a couple of key terminologies that you're expected to know is what I'm going to go over. But before I do that, I want to make sure you have the clear distinction between financial accounting and financial management. Financial management, unlike financial accounting, is going to use the cash flow information to make decisions as to whether to buy or sell an asset, whether to invest in this product or not in that product. It may also use information about break-even analysis. How much revenues do I need to make so that I make zero profit or loss? In other words, how do I recover my fixed cost? So in financial management, we're going to use the accounting information that we just talked about to make certain operational, certain financing, certain capital or investing decisions. And that's what we're going to focus on, financial management. Now, here are the key terminologies that we expect you to understand. First one is accrued expenses. An accrued expense means unpaid, not paid. If you stay in an apartment, you have rent, and you haven't paid it yet, we call that accrued rent or unpaid rent. It's a liability. It could also be an unpaid salaries. It could be unpaid any expenses. So as long as you have not paid it, we say that it's accrued, okay? And it's very important to put that as a liability and also to increase your expenses for that. The next thing to understand is what we call accumulated depreciation. Depreciation just means using a building, using a car, using a computer, using any fixed asset. When you use that, we use the word depreciation. So for example, if I bought a laptop for $2,500 and I think the laptop is going to last for 10 years, then I divide the 2,500 by 10 and I get $250 a year. So every year I just estimate that I have used 250 of that, and I call that depreciation expense. That's all it is. It's a systematic process of allocating the cost of an asset, a fixed asset, over its economic useful life. Now, the depreciation for this year is 250. The depreciation for next year is 250. You get a total of 500. That's what we call accumulated depreciation or total depreciation, accumulated depreciation. Now, next on the list is amortization. Amortization is the sister of depreciation. If you are talking about intangible assets, we don't use the word depreciation, we use the word amortization. So for example, if I have a TV license that costs $10,000 and I think the license is for 10 years, then I'll divide the $10,000 by 10 years and I'll get $1,000 a year. Instead of calling it depreciation, no, I'll call it amortization because it's related to an intangible asset. Now, next is what we call balloon payment. A balloon payment just means that you paid at once. So let's say you buy a car and then you get a loan for it, okay? And that loan, instead of paying it over every month, a little bit at a time, you wait till year 5 and you pay all of it. So it's a balloon payment. That's what a balloon payment means. As opposed to a barbell payment where it is like twice. You pay half of it here, you pay the other half here. Or it can even be laddered payment where you pay a little bit at a time. Or it could just be an amortized payment where you pay a little bit each time until you get to the end. So don't forget that, all right? Capital or equity, we have already explained it as net assets or asset minus liabilities. You know what it is. A capital campaign is when you go out to your donors, your investors, and say, hey, I need money to do this great thing in my business. Can you please give me some money? And that is what a capital campaign is. A grant receivable is grants that you expect to receive. Whenever you hear the word receivable, it means you have provided your services, but you haven't received the money yet. You receive it in the future, right? So we can have an accounts receivable if you sell goods and services and you will receive the money in the future. We can have a grant receivable. You've written a grant, you've put in your bid, you've done your service, you haven't received the money yet. We call it a receivable. Okay, it's an asset. Every time you hear the word receivable, that means you have an asset. And then there's something that we call in-kind contribution. So instead of me giving money to my favorite charity, I give my time. That's in-kind. Or sometimes people will give buildings or give other things instead of money. Okay, so make sure you understand that. Liquidity just means cash, closeness or nearness to cash. If you have cash, you are very liquid. If the asset is difficult to convert into cash, it is not liquid. It is illiquid. All right. So a building is illiquid because it's hard to sell a building and realize it into cash. But cash itself or cash equivalents or accounts receivable is very liquid because it's easy to convert that into cash. Next is LLC. That acronym LLC stands for Limited Liability Company and is to be differentiated from an S Corp or a sole proprietorship or other form of business organization. Why is it limited? Because the liabilities of the company are restricted to the amount that you've invested in the company. So let's say I started an LLC and I put in $10,000. If somebody sues me, they can get from the business up to $10,000. They cannot get any more than that. I've explained what net asset means. It just means capital. It just means equity. So I'm not going to belabor the point. Now, ratio analysis is when you compare one number on the balance sheet to another number on the income statement or vice versa. Typically, we have what we call two types of ratios. One is the pure ratio when you compare numbers on the balance sheet only, or when you compare numbers on the income statement only. And then we also have mixed ratios, which is when you compare numbers across the statement, balance sheet to income statement and stuff like that. There's four main types of ratios that you should be aware of. One is what we call profitability ratio, where you take your net income or your net profit and divide it by, let's say, your sales, or you divide it by your total assets. We call that profitability ratio, okay? Next type of ratio is what we call activity ratio. We're going to get into a lot more detail about that. We also have solvency or debt ratios, and we have market ratios, which we'll be talking about in other lectures. Now I'm going to differentiate between short-term debt and long-term debt. Short-term debt means debt that you have to pay within 12 months, and long-term debt is when you have to pay after 12 months. So a mortgage, a long-term mortgage for 15 years is a long-term debt. Short-term debt, like a bank loan for 1 year, or even if you like, all those are short-term because you have to pay them within 12 months. Last but not the least is working capital. And working capital means your current asset minus your current liabilities. Current assets, when we talk about current assets, what we're talking about really is cash, accounts receivable, inventory, prepaid asset. And then current liabilities will be accounts payable and all short-term debt, okay? If you sum all the numbers together, you subtract your current liabilities from your current asset, the amount you get is current, what we call working capital. So let's say your current assets is 100, your current liabilities is 80, you get a difference of 20. The 20, we call it working capital. I hope you enjoyed this presentation. Peace out.